What is up, guys? My name is Gustavo from Gustavo's Finances, and today I want to talk to you guys about bonds, what a bond is, and to get you a little familiar about what a bond does and how a bond is created. Now, I'm going to do things a little bit differently today. I actually learned how to do these bonds through a presentation on a slide, so I just wanted to recreate that and see if people can understand better visually, because I know I'm a visual learner. And sorry for the change of scene. I actually moved into my new apartment, and so yeah, this pretty basic background. Hopefully I'll make it look better and stuff for you guys, but carry on with the video.
So, what is a bond? A bond, I want you guys to look at it as a loan, because a bond is basically a loan. So a bond is a loan that an investor provides to a company or government. Now pay attention, because CFO is an important person when creating a bond. So the CFO is the Chief Financial Officer. His responsibility is to report accurately and timely historic information to the company. Now he is also the person to go into an investment bank when he needs money for a project. So if the CFO needs money in order to build their next corporate building, he would actually go to an investment bank. So the CFO would then go to an investment bank in order to get the loan he needs for the corporate's building. Now here's an example. The CFO would need $500 million for his building. The bank would then value the CFO's company and make sure the company isn't a bad investment. Now they do this by checking their income statements, their financial reports, and their cash flow. Basically how you would value a company when looking for stocks. Now if the CFO's company meets the requirements, then the bank actually gives them the loan. And then here it is, the bank giving them that $500 million loan. Now, so since the CFO got granted those $500 million, the bank then creates 500,000 bonds. Now, one bond is equivalent to $1,000, so therefore 500,000 times 1,000 is 500 million. Okay, so the par value. The par value is basically the initial value of the bond. It's not how much the bond costs, but it's the value of the bond. So therefore, the bank is going to charge you like $5 to $10 more, so 1,010, 1,005 per each bond. That's how the banks make their money. Okay, and so the par value doesn't change. The bond is worth $1,000 at the end of the term. So the term would be 30 years in this example. At the end of this term, the bond would then become mature and you'd receive this $1,000 investment back. Now the coupon rate is 5%. This means 5% from the initial value of the bond. So 5% of 1,000 is $50. So every year you'd be getting $50. Now this is when the investors come in. The investors actually purchase the 500,000 bonds from the bank. So you, the investor, would purchase this bond. Now this is what a bond looks like. Back in the day, they used to have like a big old book that people got sent, and this is kind of what it would look like. But nowadays everything's electronic, so it's not really like this anymore. Everything just happens, electronically. So this is the real estate empires. This is basically the company of the CFO. So here we go again. The par value is 1,000. The coupon rate is 5% annual. So you get $50 annually for holding the bond. Now they actually pay you like every 6 months. So you'd get $25 for the first 6 months, and then $25 for the other 6 months, and then that would be your 1-year coupon. You'd actually receive your $50 if you would redeem these coupons. Now, like I said before, this is the term, this is when you bought it, and then this is when it becomes mature. When a bond term is completed, the bond then becomes mature. So once the bond is mature, you receive your initial $1,000 investment back from the company. Now there's some risk with bonds, so the company could fail, or if you have like a federal bond, then the government could fail. But usually when you have a federal bond, there's not really that much risk involved, because the federal government can just print more money. anyways, another risk is interest rates. They could change. So if you had a 5% bond and the bond's now dropped to 4%, what I put here is a coupon rate. So you remember those 5%, you'd actually have $50. Well, now it would be a 4% bond, so it wouldn't be $50 anymore. Now bonds would now be 4% instead of 5%. Okay, but those who still have those 5% bonds would have a higher value bond. So for example, if you were to buy a 5% bond and 2 years later it would drop down to 4%, your bond doesn't drop down to 4%. You keep the 5% bond until the end of the term. So you actually benefit from this because now your bond is higher value than anyone else's. No one else can get what you have, and so you basically have the better bond. Now inflation can also be a risk. So if you had a 5% bond and inflation is 4%, you'd only be making 1%, and that's not a lot of money. That's a horrible investment in my opinion. So you must include this factor when valuing a bond. So for example, like this 5% bond, we have like a 2.2 inflation rate. So you'd have like a like almost like a 3% bond, which is you could find better out there. Now let's say your bond or the company goes bankrupt and you're holding a bond. So the good thing about bonds is that you're the first person to get paid when the company gets bankrupt. Now notice they are bankrupt, so they don't have a lot of money. So don't think you're going to get a lot of money back. But you're actually the first person they would pay, so the equity distribution. Whatever they have left goes to the bondholders first, then the preferred shareholders, and then the common shareholders.
That is all I have for today, guys. I hope you enjoyed the video. I hope you learned what a bond is and how it works now. Bonds are actually very beneficial for you. I know Warren Buffett actually uses bonds and buys stocks as well. So like let's say his stock price, its returns are like 3%. If they have a bond and the bond is 5% return, then obviously he's going to go get the bond because it's a better deal. And so if you learn how to use those two very well, then you'd actually maximize profits, and you'd actually have a lot better outcome in the market. But like I said, that is all I have for today, guys. Thank you for sticking around. If you liked the video, give me a thumbs up. If you have any questions, comment down below. If you want to see more, subscribe. Thank you.